Right, terrific. So, look, we're on time. Priva is with us. So she had some technical difficulties initially. For those who are wondering why we are slightly out of order, just joining us more recently, Treva couldn't Zoom problems, but she's on with us now. So, um, Christine, if you can promote Treva onto the panel, and Adam, you're sharing Treva's screen for us. Great. Okay, let me do a quick introduction. So, for those who don't know Treva Klingbeil, Treva is as an absolute doyen of the uranium industry. She's been involved in the nuclear fuel cycle for 3 decades. She founded TradeTech in 1995, and TradeTech is the leading advisor consulting group, price monitor in the industry. If you're not a subscriber to the TradeTech service, I encourage you to log onto their website and get access to their material. It is all fantastic. So, Treva, this is I think the fifth time we've had you as our opening speaker on our conference, and your insights are always extremely valuable. So, over to you, and look forward to hearing your comments.
Thank you, Andrew. Let me start my video, apparently. There we go. Here you can see me. Great.
There we go. We can see you. Terrific.
All right. And you can hear me. Great. Thank you for that really kind introduction. And it's a pleasure to be back with you guys again. And thank you to John and to Per for sort of kicking it off as I had technical difficulties. And I have to say, they really covered a lot of material that I'm going to touch on and reinforce some of the things I'm going to say. So hopefully this will bring together a really good picture for everybody. So, but before we get started, I need to draw your attention to our standard disclaimer, which is shown here, that cautions against making any investment decisions based upon my comments today. So with that out of the way, let's get started with what is the leading issue in our market, which is the prospect of sanctions on the import of Russian nuclear fuel into the United States. There have been several drafts of bills that would ban Russian uranium imports to the U.S., and a few have advanced quite far in the House and Senate. Now, all of these bills are aimed at further curtailing Russian nuclear fuel imports into the United States. The bills that have received perhaps the most attention are companion bills in the House and Senate, which would ban the import of Russian nuclear fuel 90 days after the bill becomes law. On December 14th, and Per addressed this, the U.S. Senate version nearly passed, but it was blocked by one vote belonging to Senator Ted Cruz, who is a Republican out of Texas. Just recently, a U.S. House Foreign Affairs Committee held a meeting concerning Rosatom and Russian uranium imports, which included a discussion with expert witnesses on the relevance and the potential success of sanctions on Rosatom and certain subsidiaries. The concern of certain members of Congress is that Rosatom's position within the global nuclear market is getting stronger, and the longer the U.S. waits to act, the more difficult it will be to address Rosatom's reach. So Congress continues to consider sanctions and the effectiveness of proposed actions. And we think and agree with Per and John that we will see those sanctions. But it really doesn't matter, because Russia's invasion of Ukraine has already fundamentally altered the uranium market by shifting buyer preference towards non-CIS affiliated sources of supply. And we know there was already significant upward pressure on price. So while sanctions against nuclear fuel imports have yet to emerge in the US, as each day passes without an end to the war in Ukraine, the prospect of those sanctions grows larger, especially as the US government has indicated that it supports sanctions. Just last week, U.S. Energy Secretary Jennifer Granholm said she encouraged Congress to ban uranium supplies from Russia, because doing so would free up those funds that Per referred to support domestic development of fuel for next generation nuclear reactors. Now, adding to the uncertainty around sanctions is the prospect that existing sanctions on other goods and services might impact nuclear fuel. And in fact, we've seen some examples of this over the last 2 years, and Per referred to one of those that has happened recently. A shipment of Russian enriched uranium product, EUP, that was destined for Maryland made a routine stop in a German port for operational issues, but it has not yet been given permission to leave. And German authorities are holding the shipment due to the presence of plywood, as Per mentioned, that is used for ballast. But it also happens to be on the sanctions list of products that the European Union has banned. Now, this kind of issue just reminds us of the layer of risk that is there with respect to timely delivery of Russian nuclear fuel, but it also highlights other logistical challenges that we see in the market today. These kinds of challenges, which have been isolated to Russian exports, have started to impact other suppliers as well. BHP is now diverting nearly all of its shipments from Asia to Europe away from the Red Sea, the latest display of the effects of Houthi attacks in the region on global trade. BHP shipments originating from Asia are now reaching Europe through a longer route that passes by the Cape of Good Hope on the southern tip of Africa. Now, this longer route adds 9 days and several thousand nautical miles to the journey, which naturally translates into higher shipping costs compared with a more direct route passage through the Red Sea. We also have seen dock workers and longshoremen protest and threaten to strike over Russian imports. So that presents another risk in this space. And these types of challenges represent are expensive to rectify, and they can be compounded if they cause downstream issues such as mismatches in delivery locations because of delays or non-delivery. Securing timely and smooth book transfers between different facilities, which was once a given in this market, has now become increasingly difficult. And combined with tightening restrictions around the acceptance of Russian nuclear fuel at various facilities, it's just added further complication to a very strained market. Now, another issue that has held the attention of the market, and again, it was referenced by John and Per, and we're going to dive into it, is Kazatompром's production plans for 24 and beyond. Kazatomprom recently revised its 24 uranium production volumes downward, which caused a very big stir in the market. Prices responded by jumping up to $107, partially on this news. And speculation ran rampant around how this would ultimately impact Kazamprom, Cameco, Orano, and even Rosatom or Uranium 1 production. Kazatomprom's 2024 uranium production volumes are expected to be in the range of 54.6 to 58.5 million pounds on a 100% basis and 28.3 or 30.9 million pounds on an attributable basis. The company noted in its Q4 and full year operating results released on February 1 that adjustments to its previously announced production projections were due to challenges, as we've mentioned, related to the availability of sulfuric acid and construction delays at newly developed deposits. While the production volume for the majority of its uranium operations will be approximately 20% below the level stipulated in subsoil use agreements, Kazatomprom has indicated it does expect a modest increase in growth in output in 2024, but like Per and John, I think that there is some question about whether they'll really be able to achieve that. Now, with respect to the company's shipments, Kazatomprom has said it has effectively leveraged the Trans-Caspian route during 2023, with 64% of all uranium shipments originating in Kazakhstan and destined for Western markets now traveling via the Trans-Caspian route. For its part, Cameco expects to weather this interruption in Kazatomprom production by utilizing a variety of tools, including some inventories and its diverse asset portfolio. Now, what that exactly means, we think, is a variety of things, including, as Per and John mentioned, some renegotiation of existing contracts. We expect Orano to take a similar approach, though its production in Niger does present yet another complication for the French producer, and each of the developments we've discussed thus far have had a pretty significant impact on price. TradeTech's weekly spot price reached historic highs in the last few months, peaking at $107 per pound in early February. The price has since come down to $88. And one of the reasons for the recent dip in prices is that a number of financial entities have decided to take advantage of the price rise by selling some of their physical inventories. However, these entities have not offered large volumes, and since that material is cleared, the price is on the move up again, in part due to the uncertainty around the Russian sanctions we just talked about. Now, I'm going to cover more about that in a minute, but first I want to note that this level of price volatility is likely to remain a feature in the spot market for some time to come. I also want to note that TradeTech's long-term and mid-term prices are also up significantly over the last year and a half to $75, now approaching $80, $85, and $100 respectively. Several factors are behind the overall rise in these prices. This includes the existing supply deficit, increased spot market buying by producers, physical funds, and other intermediaries, and uncertainty about development progress among emerging producers. And all of this is happening in a global environment largely defined by geopolitical unrest, increasing demand related to climate change initiatives, and uncertainty surrounding Russian nuclear fuel exports. TradeTech's production cost indicator is also up to $56.70 per pound, which is shown in the chart in yellow. Now, note that the PCI has risen as buyers recognize that higher prices are needed to incentivize new production. So while the price had been above the psychologically significant $100 per pound level for the last 6 weeks, a lack of buyer interest has tested the resiliency of recent price levels. Still, the spot uranium price has trended upwards for the last several years, and it shows notable volatility along the way, which has reflected the diverse interests, expectations, and externalities at play in the market. And that has meant a spot price that has increased 5% on average to $88 per pound today. That's an average increase of 4% increase week to week, with the movement in the price on any given day over that period, up or down, often exceeds that. So on a weekly basis, since September, the spot price has moved by as much as $7 a pound week to week and currently exhibits annualized volatility of 30%. Yet the underlying market fundamentals, which today are characterized by increasing policy support on the demand side, again reiterating what John and Per said, and undersupply on the supply side, they remain largely unaffected by the discrete events that drive week-to-week variations in the price. And those fundamentals are clearly shown when looking at demand versus supply. What we see here on this chart is a notable gap between global uranium requirements, shown by the yellow line, and the established production base, including secondary supplies that's shown by the blue column. And what you'll notice is that the gap widens over time as the production base is depleted. And the resulting deficit must be filled by new production, amounting to around 100 million pounds U3O8 by 2035. And we do not see demand for nuclear fuel, whether in the Western or global markets, easing anytime soon. And that's mainly because we see demand rising steadily over the next several years. China represents not only a significant increase in capacity, but they also offer a compelling sales opportunity for uranium producers. Now, China does have a large stockpile, but they have shown a preference for ownership in uranium production companies, and they've also proven to be quite flexible. They take a significant amount of material from Kazakhstan, but they also buy on the global spot and term markets. And beyond China, we see encouraging developments in India, the UK, Eastern Europe, and South Korea. And we're seeing remarkable progress in the developments of SMRs, mainly in Canada, the US, the UK, and elsewhere. And we're facing a future defined by higher energy demand. As reported by Bloomberg, By 2030, the surge in AI alone means US data centers may gobble up more power than households. We simply need more electricity generating capacity, and current policies are steering us towards carbon-free sources of power like nuclear. And that expected growth, coupled with significant current requirements, is putting a lot of pressure on scheduled uranium production to meet the demands of the current and future fleet of nuclear reactors. And the utilities are responding to this by buying, and they're locking up significant quantities for delivery out in time. What we can see in this chart is that in 2022 and 23, volumes transacted in the term market were well above average, which is shown by the yellow line. In fact, 2023 represented the second largest year in term contracting over the period from 2001. Now, some of this is accounted for by existing producers securing substantial supply arrangements, partly by negotiating around existing agreements with existing customers. And Cameco has done this, as have Kazamprom and Uranium. Several other suppliers have taken a similar approach, while some buyers have approached the market both through off-market discussions as well as public RFPs. And I think this is an important thing to keep in mind. In some cases with those RFPs, more than one offer was accepted, and perhaps more importantly, we have seen the emerging producers securing deals. Energy Fuels, Global Atomic, Encore, Paladin, UR Energy, to name a few. All of this has pushed the total of term contracts between 2022 and 23 above 280 million pounds, with a notable share of that volume going to emerging producers with delivery dates that extend from the mid-2020s through the early and now mid-2030s. Now, shifting back to prices, the recent rise in uranium prices has also shifted the power balance in the market from a buyer's market, which persisted from roughly 2012 through 2021, to the seller's market we see today. And this power is evidenced by the shift in recent contracting terms. Certainly, for the well-positioned seller, these higher prices represent a long-awaited opportunity to seize market share and to capitalize on future production. So while there is significant pressures on suppliers to bring new supply to market, and there is the question about where new supply will come from, it does present a significant quandary for emerging producers, because given that the supply deficit in the market has no immediate solution, the temptation is to wait and let prices rise and rise. And since the deficit seems to have no end in sight, there is a temptation to predict that the seller's market of today will last for a long time, at least until the supply-demand balance trends towards equilibrium. After all, that's what the supply-demand charts show us. But history teaches us an important lesson here too, and it's that this market innovates. Old projects become economical at new price levels. Governments intervene. Electricity production, after all, is a matter of national security. Something will happen to change the market. The supply-demand fundamentals will evolve. We expect some innovation, intervention, or other interruption will occur. And while buyers can use the spot price to tell them the sentiment of the day, the long-term market is marching steadily upward on supply-demand fundamentals. So while today sellers have benefited from the self-imposed bifurcation in the market and from the existing supply deficit, I want to caution both buyers and sellers against assuming that you will always have the market power. For now, the power is clearly tipped towards sellers, and the question remains, where will the pounds come from to bridge the gap between supply and demand, and when? That concludes my comments, and I'll wait for questions from you, Andrew.
Fantastic, Trina. Always great insights, as I said. Look on that final point. I mean, that is actually the crucial point, isn't it? At the end of the day, supply always does equal demand. In retrospect, you can't not have markets being balanced. At the moment, we're still looking down, the outlook being deficits of 30 to 40 million pounds, per annum for
Right.
the next 3 or 4 years. So what will happen? Yeah, how if looking wind the clock forward here, Treva, to 2028, and we're looking back at the last 4 years.
Mm-hmm.
How does supply and demand balance out in that period? Do we see demand destruction? Do we see volumes coming off, or do we see supply appearing from somewhere that we're just completely, blind to us at the moment? Or do we see, as you might have hinted there, that governments get involved and we start to see some of these physical trusts being forced to release inventory into the market?
Well, I think for us, we see a couple of things between now and maybe I'll stretch that to 2030. I'm going to take some liberties here and stretch this to 2030. And we do see that with these current prices, a lot of projects that we would not have included in our supply forecast 2 years ago now will be included and would be profitable. So there are a lot of projects that people have in the back of their memory that they've always thought of as being uneconomic that now become economic. Now, can they get them up and started in time? They can't necessarily do that without 5, 6, 7 years, but there's the projects that have been identified, they've been explored, and they can become profitable with enough time. So we do see that some projects will move into the economic sort of arena, which have been excluded from our supply base. The other thing is that there is innovation. We talked a lot about the need for new electricity because of what's happening with AI. And we think that innovation will extend into the nuclear arena, and we'll see some innovations where we'll be able to have new technologies and perhaps see some innovation there. For instance, one of the things that we're waiting for and looking at, and we saw today they did not put in a proposal to DOE, was GLE with their Silex laser extraction. They could provide some conversion and some material to the market if they get that facility up and operating. But again, one of the things here is that we do think it needs, in fact, some government intervention, which means funding. I don't think it means forcing people to sell pounds, but it does mean providing funding, because even though prices are high, it takes more than that to incentivize some of this new production. It takes certainty. It takes assurance. And so with some jumpstart, some funding, we do think that some of these projects could get off the ground and help to bridge that gap. So that's what we think will happen. We think we'll see government intervention, and it will be in the way of funding. And unfortunately, or fortunately, depending on which side of the fence you sit on, we do expect that you'll see sanctions on Russia in the US.
What would be really fascinating for this audience is just a bit of an insight into how you go about the price discovery process. So when you talk about the spot price, being $88 a pound or where it is right now, and you talk about your medium term and your long term contract pricing at those levels, how do you actually? What's the process you go through to determine what those prices are?
Oh, well, each one is different because they represent different things, right? Production cost indicator is very different than looking at the spot price, for instance, which is based on current day-to-day activity in the spot market. A large part of that might represent what Sprot's doing or other parties are doing in terms of spot activity day-to-day. When we look at the long-term market, we're looking also at transactions that have occurred over the month that have closed, and we have really good insight into that through utilities and through the suppliers who do price reporting with us. In terms of the cost indicator, we do have a model, and we have 2 geologists on staff, and we spend a lot of time looking at individual projects, looking at their life of mine, full costs to bring those projects online. So we look at them project by project to build that up. But remember, the PCI is not looking at all producers. It's looking at those projects that will be needed to basically clear the market, the emerging production that's needed to fill the gap within the next 6 to 8 years. So it's got a very defined sort of definition around it and time frame around it, which is really that lead time that John referred to very early in his comments that are needed for utilities to come to market and contract. And
Yeah,
that number, I should point out, does not include a return on their investment or profit. It is strictly the cost of digging it out of the ground. And that has helped sort of bridge the gap between buyers and sellers who didn't know where to start when they started negotiating a few years ago. It sort of sets the stage. Okay, at least we know how much it takes you to actually just get it out of the ground. Now let's talk about what's reasonable in terms of your needs and our needs to reach an agreement on a contract.
yeah. Obviously, Trevor, there are lots of different aspects to term contracts. Price just being one of them. There's flexibility in volumes. There's floors and ceilings. There's indexation on those numbers. In a seller's market, as we're moving into now, it feels like there is a bit more flexibility coming onto the producer's side and be able to negotiate those contracts. For example, I think we're hearing that there are now escalation clauses in both the floors and ceilings in some of these contracts, which we haven't seen before. Can you give us any insights into what you're seeing in terms of the nature of the contracting that's going on at the moment?
Yeah, I'll be happy to share that. I mean, our last published long-term price was 75, but we only published that once a month, and we're approaching the end of March, so that will be updated. And I can tell you that we are seeing contracts that are above that. We're approaching 80 and higher for the base price. Now that's the base price. But what's happening now is that suppliers are wanting to get both security by locking in a base price, and they want to have some upside exposure to the market because we've talked about the potential for the price to move up, as we've just been discussing. So what they'll do is they'll have a market-related component associated, and that's what we call a hybrid contract. And so 60% of the price might be based on the market at the time of delivery. So in 2028, whatever the spot price is, 60% of the price on that delivery might be based on that current spot price. But now we'll have floors and ceilings around it. And we're talking about ceilings that are up and above 120 in most contracts today. So, but those numbers are being escalated. So keep that in mind for future deliveries. So that's what we're seeing right now, which is quite a departure from what we've seen even a year ago. One of the other things that's changed is suppliers want much longer notification periods. They used to take short notification periods, and they used to very often you would see 20 to 25% flexibility, where the buyer could exercise and let the seller know whether they wanted plus or minus 20% of the volume that was indicated in the annual delivery for that contract. That's shrinking, and less of that flexibility is being given to buyers today. So we see a lot of things that are tipping towards the seller's favor.
Yeah, great. In terms of the some of the fundamentals around demand, one of the the intriguing new things in the nuclear industry is the advent of these small modular reactors, and I think there's a lot of misinformation around about what these are and how they're going, and particularly here in the Australian context, you're probably not familiar with it, Trevor, but there's a political debate going on in Australia right now around nuclear as a potential energy source for us, and the government, which is sort of anti-nuclear, is cherry picking some particular SMR projects to say that it's they're not working, they're too costly, and they've been abandoned. What are you seeing globally around SMRs, and is this a viable new technology, and are you adding that into your demand profiles?
Yes. So we're at TradeTech, I will tell you, we're very positive about SMRs and the future for SMRs and growth there. However, we are a bit cautious about including major demand numbers in the forecast today. And one of the reasons for that is because there are about 83 different technologies and companies that are floating around today. And we do need to see some consolidation and sort of shakeout. And that's where the innovation and technology will likely come. I will tell you that we really see high promise for a lot of the SMR technologies that utilize the current fuel that's used in the light water reactors that are operating today, just on a smaller scale, because it doesn't require creating HALEU and other very complicated sort of technologies. But there are some advanced technologies that really offer promise as well. So we do see the promise of SMRs. We do see that they can add tremendous value in the future and will add demand. But that's probably, for instance, the first one we really see coming online will be in Canada in 2028. And they're making tremendous progress and really devoting a lot of attention to that and commitment in Canada to SMRs. So we think it has great promise. I think it's a little premature to try to predict which of the technologies should be included in the forecast. And that sort of dictates what the demand will be depending on the technology that's deployed. So the answer is we're really excited about it. You will hear a lot of negative stuff around SMRs, which unfortunately sort of came out of what happened with NuScale here in the US. And that was really an isolated instance, in our opinion, because we knew they were in a community that wasn't really on board with it, and their costs did move up. But that's one small example. It's not really indicative of what's happening with SMRs, nor globally.
Yeah, great. Treva, we've hit your time there at 10:30. Thank you so much for your flexibility. Apologies, we shifted you, and you're
no. Thank you for being so patient, and big thanks to John and Per, because I think they set the stage, and I hope we reinforced each other with our discussion.
You did indeed. It was good to see there was no contradictory views there at all. I think I think that's fairly obvious. Anyone who's doing any work or any understanding of the nuclear industry at the moment, is uniformly going to come out on a fairly positive outlook on the industry, because it's very interesting juncture. So, Treva, thank you for your insights. They're always very good to hear, and we look forward to having you back again at our next conference when we're on the next one.
Thanks, Andrew. I appreciate it very much.